Hi, everyone. Thank you all so much again for taking time out of your Tuesday evening to join us for this Ask Me Anything live session. My name is Amanda. I'm the country manager of StashAway in Singapore. Today's session is actually going to be a walkthrough of our recently launched StashAway Thematic Portfolios. And what we're also going to do is have an Ask Me Anything session live. So if you have any questions throughout the session today or even right now, please feel free to post it in the Q&A box that you see at the bottom of the screen. So the kind of flow for today is that Freddy is going to be taking us through a couple of slides just to introduce the new portfolios that we just launched. And then after that, I will be moderating the questions and posing it to Freddy and Stephanie. So let me just quickly also introduce the two kind of panelists that we have on the session today. The first one is, as you can see on the screen, Freddy, who is our co-founder and chief investment officer. And we also have Stephanie, who is our deputy chief investment officer and head of StashAway Hong Kong as well, to answer any questions that you might have about thematic portfolios in general, as well as the ones that is specific to StashAway. All right. So what I'm going to do now is maybe head it over to Freddy to kind of take us away with the slides. Thank you, Freddy.
Well, thanks, Amanda, for the introduction, and thanks, Stephanie, for joining, and to the rest of the participants who spend the time to come and hear us out about this very exciting launches of our thematic portfolios. As you knew, we launched them a couple of weeks ago, and these teams are the very beginning of a series of teams that we will be launching in the future. But we felt personally that these three teams represented some of the most exciting, fascinating, and game-changing trends and phenomena that has a potential to greatly alter and have huge impact on societies. So, and that's why we want to find ways to invest in them. So for the starter, what do we mean by thematic investing? It is actually a form of investing that sort of identifies the game-changing trends and phenomena that we see, and that they have this long-term potential to change society and the environments we are in. And so these are things that people would see every day, but not exactly know what's powering them. And we have identified a couple where we would drill down from a very top level down to a very, very sub-segments level to try to hone into more precision with what's available for investors to get access to, and rather than just a very loosely defined storytelling, right? So thematic investing is truly about investing in game-changing stuff that we'll see in our lifetimes. Now, this diagram is a great way to explain it. As you can tell, there's this big overarching mega trend, but a lot of times they are too vague for investors to be useful to investors. For example, urbanization is a good example. It can mean anything. It can mean a lot of stuff. But urbanization can be drilled down further into something more concrete. And in this case, smart cities is one very good way of saying, well, urbanizing cities, urbanizing societies, and now involved in the latest tweak to the latest trend involves the building of smart cities. But what smart cities does is, well, smart cities will involve mobility. Mobility could include things like electric vehicles, or maybe clean technology, clean energy, better water processing, and a lot of different things that can make up smart cities. And StashAway found that the sweet spot for investors would be to narrow down the big team into actionable chunks. And in this case, the team is better than a mega trend for investors, but the sub teams is where it's really useful. And in this case, we're showing you here the sweet spot is electric vehicles, or maybe even new researchers into battery lives or what have you. Depending on how you define the team, the sub team could be the very important places to start with. And this beats having just owning a single stock in this case, because in electric vehicle, whether you're investing in Tesla or NIO, the concentration risk is absolutely too high. Volatility is too high, and it is really way too risky for the average investors to take on. So having a team and identifying the sub teams actually created a first line defense where StashAway can find diversification from the sub-teams to build portfolios with. So the concept of sweet spots in teams is really down to trying to find diversification within the team as a first line of defense. Now, we have identified and launched 3 very interesting teams in September itself. And on the left, we have technology enablers. And these are stuff that impacts how the world operates. All these core technologies such as artificial intelligence, even blockchain is becoming more and more prevalent. Cloud computing, robotics, and semiconductors, they all have various different roles ranging from hardware to software, but they are the back-end engine that powers how we live, how the world operates over time, right? And the middle team is, we call it the future consumer tech. It's sort of, again, it's the back-end stuff that powers how we purchase stuff online, how we live, how we order food, how we actually move and connect with each other. And the sub-teams make it more clear in the sense that, well, e-commerce is how we deal online, but there's also gaming, there's internet, there's mobility, there's social media. So there's a lot of sub-segments of the team that we can narrow it down very precisely to create a portfolio with. And on the right-hand side, we have something I personally felt strongly about as well, which is solely about healthcare. And in particular, the innovation side of healthcare, things that involves, whether it's COVID-19 or pre-COVID-19, there were a lot of fascinating stuff that's happened in this space. Biotech aside, we have genomics, immunology, medical devices, and pharmaceuticals. So really exciting stuff. And in a way, the pandemic has accelerated a lot of reforms in particularly healthcare innovations. So these are really, the 3 things that we felt has a very huge impact potential on societies and our environments in the next 5, 10, 20, 30 years. And is what better time than now on the cliff of another revolution in terms of technology, what better time than today to start thinking about them. Now, and then if you step back a bit beyond the thematic portfolios, we also want to highlight how does it work at StashAway, why StashAway's thematic portfolios. Well, first of all, in the industry, the risk profiling is really lacking so far in terms of a team. When we look at all the stuff that's been sold and all the portfolios that's been curated for storyline, a lot of times the people neglect to identify the user's risk profile. And what we have here is that for the same team, we actually mix in those thematic exposure with a basket of protective assets, or we call them the balancing assets, so that we can recreate your risk profile. And a particular team could be more volatile if you have 100% exposure, but your natural risk preference and tolerance may not be suitable for 100% exposure. That's when you want to bring your StashAway risk index down to your natural habitat, and the mixture of the protective assets really help us get there. And so that philosophy of risk management, risk ratings remains unchanged like the rest of our global portfolios. So the risk mitigated approach, which is so badly lacking industry-wide, remains in assistance with this thematic portfolios on StashAway's platform. And second, diversification goes 2 layers. The first layer being, as I mentioned earlier, you try to drill down into more precision of a big team into sub-teams that can be very differentiated. They might be correlated, sometimes they might not be. And we want to create a first line of diversification there. And then by the time the second line would be to add in this protective assets to create extra diversification by geography, by industries, by businesses. So that's what we always believed in. So risk mitigation, diversification remains the same. It doesn't change whether it's thematic or with our general investing portfolios. The values are the same. Thirdly, however, you got to believe in them. So it's not something that we want to sell users and that was it. we believe that the user are better served by knowing more about them. So in coming months and quarters, we'll continue to have seminars that will even involve external panel of experts that will come in to talk very specifically about a sub-theme that's in one of our thematic portfolios. And we're going to keep doing that. We're going to keep introducing those expert opinions on whether it's robotics or AI or semiconductors or blockchain. We're going to have a lot of those exciting conversations going forward beyond today. But that's to hopefully help facilitate an understanding and a sort of education for all of us, knowing more about what we invest into. And that's because we believe that the investors themselves, you got to be aspirational, you got to be passionate. You also got to believe that this team is going to change society. They're going to be a game changer for you, and then you want to benefit from it, right? So you must have that personal value system for yourself when it comes to thematic investing. Whether they're attractive in returns or not, whether there's risk mitigation or diversification or not, you must have these personal beliefs. And fourth is obviously a long-term thing. You're investing in game-changing trends and phenomena that is not the path of getting there where nobody knows, and it requires a certain mindset that's at least of a medium-term nature, long-term ideally, and that never really changed with how we invest in the rest of the platform. And so you do want to think about how you want to average into a team. You do still want to do financial planning. You still want to know exactly how much exposure you want to have in the team overall as a percentage of a net worth. Those things does not change. We are just bringing this exciting stuff to you, and giving you more choices to complement what you have existingly, what you have currently. And to that effect, we view thematic investing as a complement to your financial plans, to your general investing portfolio, rather than as a substitute. And so, and then a few things that you need is to think about is that thematic investing is differentiated. It can add diversification to the rest of what you have. And they do come with higher short-term volatility in the case of the technology enablers and also the future consumer tech. They tend to be higher volatility. So do not forget about that. Think about your risk level when you select those thematic portfolios. You can still choose a risk level that's compatible with what you prefer. And however, the more you know about the teams, the more you believe in the teams, the better it is for you. Now, again, they're not replacement for a balanced retirement plan. They rather complement, right? So these are, at the risk of repeating myself, these are really, really important things to keep in mind. We're not here to sell you more. We're here to give you more opportunities and options, but ultimately the decision reside with you, your personal values, your personal beliefs, and value systems. Those things do not change. Now, just to give you more details about how the thematic portfolios look like, for team number one, and by risk points, SI 45% means if you have a StashAway risk index of 45 on the left side, that obviously is the most risky options for the team. Not everybody should do it. But however, as you go down the risk spectrum towards the right-hand side of this table, you realize that the exposure to the team start decreasing, and the amount of protective assets and the number of protective assets, types of protective assets you have will start increasing in number to try to mix and match to give you that lower risk profile, right? So ultimately, it's a function of your risk level. Do not forget you have an option. And team number two, going back to team number one, it's very exciting. As you know, in the first 6 items, you have robotics and AI, you have next generation internet exposure, you have autonomous technology and robotics, which is quite hardware in nature. It includes electric vehicles as well. And then also semiconductors is a very interesting thing. As you know, there's a huge shortage of semiconductor supplies and chips, and also in particular countries like China investing heavily to remain to try to be more independent of relying on other nations for supply. So semiconductor itself at a global level actually gives you a very interesting play here. Then amplified transformational data is a very niche one. It is specific to blockchain projects, and in particular, a lot of promising and fascinating DeFi decentralized finance protocols will over time be more and more introduced into Amplify's ETF. And First Trust crowd computing is self-explanatory, is very focused on crowd computing itself. And so this 6 makes up this one team called technological enablers. And as you can see, the protective assets are meant to act as balancing act rather than rather than the standard way of looking at it is actually to try to be mixed in to give you your risk profile. Then in this team number 2, very exciting as well, because consumer tech is really involves a lot of these innovations as well. So the ARC Innovations ETF is in there. It has a lot of consumer related applications. So we chose it. Then you also have the All Shares Global Internet Giant ETF. And then you have the Global X FinTech ETFs, autonomous and EVs in here as well. And then you also have video gaming and esports. So some component and in particular, gaming and esports became very popular since then the pandemic. But the technology there is is improving at a rapid pace, changing at a rapid pace. So it could actually be, as a sub team, very interesting as well in terms of the consumer applications, right? And the third one is actually a less volatile risk profile in terms of team, because as you see on the leftmost column, SRI 45% being the most volatile, actually allows you to have 100% of exposure to teams. Whereas in the case of team 2 and team 1, you can't really do it. So that actually says a lot about the relative volatility between healthcare innovations versus consumer tech and versus tech enablers. So that's quite kind of sensible, because healthcare innovation's been there for a while. It's one of those very big focus, even pre-pandemic, but the pandemic has really expedited a lot of innovations here as well. So it's actually a relatively more matured innovation sector relative to the other two. Hence, at the highest risk point, you can actually have all exposure to the teams, includes medical devices, biotech, global healthcare, genomic revolution, which includes immunology as well, and then other healthcare tech and innovation chosen by various different ETF providers. We deep dive a lot into the way they structure the ETFs, how they complement each other. Hence, we came up with 7 complementary ones. And again, as you lower the risk point, you start seeing the protective assets kicked in to give you those lower risk levels. Again, I would final words in terms of thematic is we view them as complement to the rest of your portfolios or financial plans. They should be viewed as a differentiated strategy. They bring differences, they bring diversification to what you have. And also in particular, they are one big way for you to plant the next seeds for your long-term wealth. As you knew, return has to come from somewhere. And a lot of us, we instead of a lot of times when I speak with people, we tend to like when you sit them as individual, they tend to say, I like to buy low, sell high. But oftentimes the pressure from the market is so high that a lot of people end up buying high, hoping to sell higher. But thematic investing can be viewed very differently in the sense that sometimes some teams are actually temporarily underappreciated. Then they offer you a differentiated opportunity in the long term. But sometimes even the team is actually trading high historically, but because of their disruptive nature, they are expanding the pie. The innovations is creating a bigger pie over time. You can't really value them by traditional metrics. And that is particularly with thematic 1 and 2, tech enabler and consumer tech, those network effect, the ballooning size of the e-commerce industry actually would be very difficult to value by traditional metrics. So you will find that in a very different situation. Healthcare at times could be cheap, right? I'm not saying they are all cheap today. Everything is sort of fairly valued, but there are times when something is actually underappreciated, but those oftentimes will be the time when you have the least, the most negative press, most negative coverage. But some of these teams, you should always view them as planting the next seed for your long-term success. And so think about it carefully. Think about your personal beliefs and value systems first. Do the teams bring you something that aligns with your beliefs? Does a team bring you an exposure that you felt like having for the long term? You got to always take the long-term view, regardless of what happens to the market in the near term. Otherwise, planting the next seed becomes very, very difficult if the ultimate decision maker, which is you, if you couldn't commit to it, then you shouldn't be in this area of investing. You're better off with a very globalized, a general, multi-diversified portfolio, rather. Or for those of you who wanted X% of exposure to certain things, this is also an avenue. Again, think about them as next seed of all colors that you can plant for the future. And with that, I'll hand it back to Amanda. And I hope I don't bore everyone here. I think the Q&A should be more interesting. So Amanda, back to you.
Thank you, Freddy. I hope for everyone that's tuning in, I hope this created a great foundation for you to understand at least the portfolio. So we have a couple of questions that's already come in. But just a reminder for everyone, if you do have any questions, please feel free to post it in the Q&A box. And we'll try to get through as many of them as possible. All right, so maybe Freddy, let's jump right into the first one. And I guess this relates to our general investing portfolios and whether it has a component of it that is invested in the themes that we currently, three themes that we mentioned. So there's the general investing portfolio, invest in any of the three themes.
The short answer is not a lot. I don't know if, because the teams, they're very, very differentiated. And the general investing portfolios are supposed to be very generalized, very diversified across geography, industries, and everything. So it's very diluted. The thematic part of it is to strengthen it. So if some of you felt that you did not have enough tech exposure, and in our case, we happen to have a lot of China tech, but for some of you who felt that you probably needed more exposure to other forms of tech, and also outside of any particular geography, you've got more say with the thematic portfolio. You can actually hone into it, right? You can dedicate, let's say I want to have 5% in team one, another 5% in team two. You can make the decision. So I see them as complementary rather than overlapping. And the short answer is no, we do not have a lot of overlapping component with our global portfolio right now versus the three teams we see here. Not today.
Great. Thank you so much, Freddy. And next question I have is to either you or Stephanie, so feel free to jump in, which is, how often does StashAway review the components in the thematic portfolios? And essentially, what is our strategy behind it?
Well, I think it's a question directed at Stephanie or myself is fine. Well, allow me to introduce Stephanie a little bit more because she's actually the AI scientist. She has AI scientist background from Stanford, and also having worked at Goldman Sachs and a couple of investment funds as deputy CIO. She's extremely experienced with innovations investing. So she's one of the people who's had a big hand in this. And yes, we do review the portfolio component, but not from a market angle. The last thing you want to do is let the market affects your decision, because the market oftentimes underappreciate or fail to recognize the full long-term potential of disruptions, right? You look at it anywhere that the faces are very understandable. And by the time the market appreciate them and bring them to the limelight, it's a little late stage where you're paying the high. So these thematic portfolios, even though they're very liquid, the way we curate them, a high liquidity profile, but these are things that the funds invest in companies that still sort of mid-stage, up and coming, rather than the so-called in the index, like S&P 500 or NASDAQ, that level, it becomes a very late stage. So in a way, it gives you more interesting opportunities, but it does come with it a higher volatility, as I want to highlight again. So you need to select a risk profile to bring it down if you can, or you want to complement it to the overall net worth. So you do need to think about your exposure. I think, Stephanie, if you have anything to add, it would be great. Sorry, I front run your introduction.
No worries. No, I think, and thank you very much, Freddy, for the introduction. I think very similar to our core portfolios, when we selected these ETFs to be included in the thematic portfolios, they actually all pass through very, very rigorous testing in terms of the issuer quality, the size of the funds, liquidity, et cetera, et cetera. And these are trends that we expect to be very persistent over a long time period. So for example, we recommend a investment horizon at least 5 to 7 years for these thematic portfolios. And when we select the ETFs, we have that mindset as well. So that's why, as Freddy said, I mean, we're not chasing like the latest fad, but I mean, really think about longer term.
Thank you.
Thank you both. And maybe to follow up on that, that you just mentioned a little bit, maybe let's touch on the balancing assets, which is, we have a question here. What criteria do you apply when selecting a subset from the full list of balancing assets to add into the thematic portfolios?
The criteria is not specific because it depends on a complex amount of data. So how the protective list of assets comes in depends on their expected return, their volatility, and their correlation among themselves to the thematic ETFs. So, and also the lower you push your risk down, the more of those assets you need. So as you go down the very low risk spectrum, you start seeing more protective assets, more line items. It's not just the allocation amount, but also the number of protective assets increase as well. So it's really, ultimately, it's data-driven. No human being can process so much information to say, I'm going to do this amount, do that. It can't happen that way. And then I would also mention that thematic does present a set of challenges because they became popular also just for the last couple of years. And the indices will also wouldn't take you too far in data. They've done very well in the last couple of years because of the times we're in. Anything tech-driven is very well recognized. So some of the questions asking about backtest itself, the answer is the backtest look very good, but I do not believe that's the right answer. That's why we are not very focused on the backtest. Instead, our criteria includes a lot of stuff, including the thematic ETFs or the protective ETFs. We apply the same concepts, reputation of the fund manager, how much liquidity in terms of percentile ranking versus their global competitors, how well ranked they are in terms of liquidity, so that when you want to withdraw from it, you do not have a lot of trouble doing so. That to us is very important because it will gives you the flexibility to your own personal circumstances. So liquidity profile applies to all thematic ETFs or not. And also, of course, the net return, expense ratio, and tracking error, everything comes in. But I wouldn't focus too much in terms of the backtest performance because they look too good. They look really good. Like you can have ridiculous, like, I mean, some ETF, when they're this kind of thing, when they're up, they can up 100% or 90% in a year. And then, so because of the very nature, same thing with cryptocurrencies and blockchain and all the very disruptive innovations, they will have a lot of this big up and then and the volatility is quite high as well along the way. It's like an S-shaped kind of a profile. So I would strongly urge user to think about their risk profile. And if it's too high, bring it down. You mix in more balancing assets. And the decision on which balancing asset to select is a complex function of expected return, volatility, and correlation. It's not any human decision being involved here. I don't know if Stephanie have anything to add, but that's how I see it.
I think actually that's the differentiating product that we offer at StashAway, which is quite different from if you go out and just buy a ARK ETF or a combination of these ETFs. Because when thinking about what kind of balancing asset we put into these portfolios and what is the percentage of these balancing assets that we put into is, I mean, essentially the analysis and the learnings that we have from ERA, applying the same logic to these different thematic investments. And I think that is actually very, very unique in the market.
Right. I mean, yeah, exactly, Stephanie. That so far, when the way we see it is a lot of people they market teams to investors, but they do not care about the natural risk preferences of the investor. And here, what we're trying to do is say, let's take this thematic exposure. Let's first diversify them more into sub-teams to create the first line of diversification. Then in the second, let's mix in the balancing assets to give investors their own risk level that's compatible with themselves, rather than to force the risk level on them. So that's what we're trying to do in the two layer sense. So that truly for us, the standard StashAway philosophy remains applicable to teams. So
exactly, especially when we're looking at multi-year investments and potentially very high return. But again, as we have spoken at length before, high return usually comes with high volatility and high risk. And the key is to stay invested. And how we feel is that a lot of investors, when they invest in thematics, they don't have a clear idea of what is the volatility to expect. Hence, very hard to stay invested. But it is the key to a lot of these multi-year trends.
Great, thank you both. The next question that we have also is relating to, I think, when people are thinking more broadly how to allocate their funds across our general investing portfolios and the thematic portfolios, how much of one's total investment should they actually expose to the thematic portfolios that we have?
Well, I'll give you my own version that works for me, but then I'll tell you the generalized version. For me, being more in the industry and Stephanie herself, we've been investors for 20 years. We are opinionated, we research a lot, so we probably be more passionate. And I personally wouldn't mind having, in terms of healthcare innovation, for me, I feel so strongly about it. And especially since the pandemic, I would be very happy to have 10% of my total net worth in it. Because itself, and I'm going to choose, and just so everyone knows, my portfolio on StashAway's platform, my risk profile is 22, SI 22. I've raised it from 16 to 22 over the years, and I really like 20 and 22, that area. And I will continue to choose SI 22 when I'm investing 10% of my money in healthcare innovations, right? So, but overall, there's 3 teams, and the problem is that I can get too excited about everything, and I have too many teams in my portfolio. So I will put a hard limit of maybe 25% in my case, that all kinds of teams will not sum up to more than 25 because they're generally more concentrated. I still want majority of my money to be in the global core portfolio, right? Because I believe in diversification, but differentiation can come from teams. And so the amount really depends on your passion about it, the amount of knowledge or the amount of research you've done on it, right? So if I say environmental portfolio today, some of you who's very green focused, you probably will go mad and you want to do 10% right away. And again, building up to 10% is not a one-day thing. You have the option to do a regular dollar cost averaging, and over time you build it up. Yeah, you don't have to hurry, right? So that's not what we are trying to promote. We're still trying to promote that you have a target. If it's 5% is fine, or 10, it's really up to you. If it's too difficult for you to decide, just think about it. If I allocate 10% and this thing has an SRI of 45, there's a 1% chance of me losing 45% of my money. If I choose that risk point, then that means the 10% can be a 4.5% negative impact on the portfolio, right? In a bad situation. Is it something that I can handle coming from one source? If that's the case, it's fine. Or if it's not, let's choose the SRI that's lower for the team. In my case, it's SRI 22. That makes it a lot easier to allocate more and be more patient. So ultimately, it's a function of yourself, your risk tolerances, your personal values. But again, I'm giving you my own numbers because that's me. And Stephanie, I don't know about you. Maybe you take it to 20. I don't know, but
yeah, I think what Freddy said is absolutely right. It starts from your own preference, right? We have 3 themes and probably more to come, but invest in something that you're passionate about. Is expressing your own interest and what you see the world in 5 years, 10 years time. I mean, for myself, because of my background, I really like tech enabler, because I do think that a lot of these infrastructures like AI, robotics, like blockchain, and these are technologies that weren't available even when I was studying AI. So these are technologies that are changing very rapidly how the world operates in the past few years and many more years to come. And the way I think about how much I allocate is, again, I'm looking at my core portfolio, and I have to be quite honest. I'm the more risky type, so actually my core portfolio is 36, and I'm looking to spice it up. So, but then also, not taking too excessive risk. So the question I ask myself is, given the allocation I have in StashAway, what is the percentage drawdown that would make me very, very uncomfortable, or such that I cannot sleep at night? And I mean, I have my answer, like everyone have your own answer, and just spice up your portfolio using that amount. Or if you already like choosing a very high risk portfolio that is your maximum, then maybe choose the same risk index for the thematics, which is kind of what I did. So like the whole kind of rationale behind thinking about SRIs, even for thematics, is for like everyone to be able to size them using just one metric and do it like in a very, very simple manner.
Thank you both. I think I agree that's a great way to think about it. I hope it's helpful for everyone as you are evaluating the portfolios and thinking of how to allocate it with our general investing portfolios. It gives you an idea of how to think through that. So the next question that we have is maybe to drill down a little bit on the ETFs that we have in the thematic portfolios. I have two parts to this question. The first one is, I think more broadly, how did we select the ETFs? And then the second one is also, specifically, we have a question from Ray on the liquidity criteria when selecting the ETFs that we selected for the thematic portfolios.
Well, when we first do this, we did not try to have an open mind. We did not want to select anything. So we went after everything under the sun, find those ETFs that belong to the thematics, to a particular team, and then we start sorting them out. And there's so many teams out there. Then we realized that the industry is defining team in a very different way. And they're actually sub-teams, actually. Then we started thinking about, let's go across different sub-teams to make it into a coherent mega trend, right? So in this case, technology enabler, like what empower technologies of today and tomorrow, that's very loosely defined, it's not useful for investors. But when you narrow it down, actually a lot of different people have different answers. But in our case, based on what we see, all the funds that we have screened out, we screen them by their liquidity profile. We screen them by the expense ratio, tracking error, volatility profile. And then we keep an open mind there, just receive the data. And then we go, okay, among people doing the same thing, what's the best in class? Best in class in terms of net return. If they had a similar mandate, similar strategy, who had a better net return versus their volatility. The ratio is important. So there's a lot of factors that come into here, but the number one thing is liquidity. It must be sort of a percentile ranking wise globally. It must rank very well. And in particular, most of the thematic ETFs we have used, they rank into the 97, 98, 99 to the 100th percentile. A couple of them actually around 90 to 92 percentile. And so even the least liquid among them ranks in the top 10 percentile of the marketplace. So that's how we do it. We want to get as liquid as possible, right? And then the tracking error must be decent. So the criteria is very simple, really. And of course, we also have regulatory constraint as a licensed fund manager. So we do have to comply with certain restrictions on how much the complex instruments being used by the fund. Ideally, not much. They must be very, very small amount or not at all. So we have a requirement, and what's the amount of borrowing the fund uses? Ideally, no borrowing, right? And so we have very strict criteria when it comes to the risk side of things. And then we chose those ETF. And then from what we've chosen, we finally look at the story behind it, right? So it's actually reverse engineering. It's not from a story, it's actually from bottom and going to up. I don't know if Stephanie, you have any more to share, but
No, I think that was very comprehensive. So yeah, nothing much to add there.
Great. The next question that we have is on whether ERA actually applies to these portfolios as well. And also as a follow-up, will we potentially also re-optimize thematic portfolios the way we do the general investing portfolios?
Yes, ERA does apply, but with there will be some tweak. I'll explain in a bit, but generally the principle remains that in good times these things do extremely well. Some years it could be 90%, but when they're down it could be 30+%. It really depends your amount of exposure, and so ERA will apply, but to a certain extent, disruptive sectors, the histories are short. Their growth are exponential. They're expanding the pie. Traditional metrics do not apply to them, and historical data is quite useless. It's the same as looking at, say, cryptocurrencies. If you look at the price chart, I call it the S curve because it goes like this, a very long left side of the S tail, and then it goes sharply upward, take a breather as it mature, and then if you get accepted and truly change the world, it go for another S, the right side of the S curve, right? So these are the classic behavior of disruptive innovations. We call it the S curve or exponential S's. So they do present a challenge in terms of coming out with expected return. But risk is actually the easier part because in the early days of phases, they went through a lot of high volatility period. It's easy to pin down their impact on portfolio. So we can control risk with more certainty. In fact, as they mature, the volatility is coming down. And however, in terms of expected return, it's very difficult because it's non-linear, right? If you go for the last couple of years of history or even last 10 years, you sometimes see ridiculously high return, average return that's been realized. If you backtest it, it's sort of cheating yourself as well. You're talking about 90% sometimes, right? So we chose to ignore the expected return, but to sort of focus on the StashAway risk index. The StashAway risk index focuses on historically all the top 10 or top most painful scenario and see how the funds behaved. That's how it's defined. We don't look at last 1, 2, 3 years randomly. We look at only the very, very poor situation. So the SRI concept of ERA doesn't change, but the expected return part, ERA couldn't really give you, ERA will give you a return that is not going to be reflective of the past is not reflective of the future. So ERA is actually, after a lot of research, we decided to turn off the expected return part of it and focus on risk. Because anything like that could be up a lot, 10x, 2x, but you don't know how to make expectation, right? They can come suddenly when you least expected. So just focus on the risk. I don't know if Stephanie has any.
Yeah, and also I guess, right. Diversification also is very important in these sort of early stage investing. It's a little bit like investing in venture capital companies or venture capital funds, right? When you invest in a portfolio, you don't expect all the companies to succeed or to IPO, but 1 or 2 of them would provide 80%, 90% of the return of a portfolio. So that's why, I mean, for our portfolios, we also have sub-themes, and also within sub-themes, we have exposure to a large amount of companies to provide that sort of diversification that you need for this type of investment.
Right. Sorry, Amanda, I want to interject. I see a question in the chat that came in earlier, and it's from JQ Lim. It says, how will the inflationary trend affect the thematic portfolio? So it's similar related to the earlier question that ERA is still managing it, and it will still be re-optimized along with other people when economic situation change. But one observation we realized with inflation and thematic is that a lot of teams that we invest in, they benefit from inflation. In particular, as you know, disruptive tech is one of the most efficient way of outgrowing inflation. And the pandemic, the supply chain disruptions in food, materials, and even healthcare options actually created a lot of buffer for the healthcare team as well. Those innovations were spurred by the pandemic. I see them as very efficient insurance against inflationary trend, US or global. So thanks for the question, JQ. And I just seeing it, want to answer it as well, take the opportunity. So inflationary trend definitely beneficial for this kind of teams that's very progressive and exponential in growth potential. It's not a traditional asset, right? Yeah. Back to you, Amanda.
Thank you, Freddy. We're going to jump into that. I was going to jump into that question, but great that you've helped answer it already. The next one that we have is it's a question that actually a couple of people have asked already, which is, it'll be great to hear your insights and thought process into how we selected these 3 particular themes, first of all, and then also can our clients expect to see more themes in the future?
Answering the easy part first, for sure, we are working on a lot of stuff and we are launching them. It's going to be a series, which view the thematic investment as a series of new products that we will be bringing over to our user. So these three are just for starters, but they are the most exciting one that we want to launch first because we are excited about them. But I'm very excited about number 4, 5, 6 as well. And some of you may have hinted already. What about environmental stuff? What about ESG related stuff? What about clean tech, clean energy? Anything under the sun has been looked at. We are in the process of curating more. So for sure. And sorry, can you just remind me the first part of the question again?
The first part of the question is essentially what were the insights or thought process through choosing the 3 teams that we've already first launched with?
Really, it's just screening for how big are the funds, how liquid are the funds, their fees, and then the volatility profile. And then then we deep dive. We actually interacted with we interview a lot of fund managers. We've spoken a lot to them. We look at their material. For example, I can give you an example, the ARK funds. The ARK funds represent a very unique challenge to most portfolios because they're very good at doing what they're doing, identify futuristic companies, doesn't care about today's market, valuation, performances. They don't have this feedback loop with the market, but rather they focus on what phases of growth is a business today versus the future endpoint where they think the scenario they come up with, the upside in terms of the disruptions to these companies can bring outweigh the cost of entering today. They have that mindset in mind, looking for exponential growth and looking for futuristic companies. So some people may ask, well, ARK funds is actively managed. Why is StashAway using it? It's precisely because they are not actively managed against market. They're actively curated against their own research. And ARK funds only employ non-market people. Most of them, they're like all technologists, people who specialize in identifying new tech trends. And that's what we like. They are just curating the basket of companies they want to invest in, ignoring market metrics. That's what we want. And as long as they stick to their philosophies, StashAway would embrace it too. It's our decision to increase or lower or to get out. That's the decision lying with our algorithm. We don't need ARK to do that. We need ARK to focus, to commit to finding futuristic companies with exponential growth. So that is one good example. So we have interviewed a lot of the fund managers to try to understand their investment processes, how they curated their basket, how they curated their investments. So even down to that level of details. And we actually, a lot of times we're ignoring their track record in the last few years because every team has worked. They all done very well in the last few years. Let me put it this way. The back test or something is just chicken and egg. It's going to look very good. We're ignoring that. In fact, we're focusing on how they do it. We're focusing on the risk with their funds. And historically, when the maximum drawdown hits, how bad it can be, how can we sort of keep it under management. So that's why the StashAway risk index approach comes back in, right? I don't know if Stephanie has any more to add to that process, but feel free.
I guess, yeah, also maybe just to add to that, it's structural growth trends that we see over the next 5 to 10 years. So ARK have the 5 pillars, which I mean, actually part of that goes into our tech enablers, because I mean, we also agree that some of these pillars will enable us conversions of some of these technologies, like for example, AI combined with robotics or AI combined with healthcare. I mean, that's going to fundamentally change how a lot of these industries operate. And more importantly, how do they generate value for the world, right? In terms of creating new products or making things more efficient. For example, like blockchain technology, how do we make the financial system more efficient, et cetera, et cetera. And I think when we think about all these different themes, it's really the structural growth prospect of that. Instead of, for example, in ERA, we're trying to optimize for the cyclical component of the economy, of how companies respond to economy. In these thematics, we capture the long term. Maybe back to you, Amanda.
Thank you, Stephanie. Great. So the next question that we have is on kind of, as we look at each team that we have, is there any any part of it where we focus a little bit more on sub-themes within each team. So for example, how do we split the percentage of exposure within sub-sectors within a particular team? For example, SRI 30%, we have the BOTZ, the ARKW, and the ARKQ. It takes up about 12 to 16% of the portfolio, and the rest of the ETFs are just above 3% each. So is there a particular preference in sub-theme within each portfolio?
Yeah, just to thanks Amanda for raising this example right here. So BOTZ is Global X Robotics. Well, as you can see, we like we mentioned before, the way we decide this is based on first, because expected return is really not the big concern here, is more like risk. So the past drawdown will come in, and also the correlation among them will come in. So that would be the short answer. But we also have imposed a limit in terms of we don't want any particular exposure to be too much. So you can see that in this case, team number one, to get to SI 45%, we managed to cap the maximum allocation to 16.7. Anything more will not be accepted. The number will go to other places. So you have a smaller amount of blockchain, right? So we also impose limits because we want to make sure we reduce the concentration risk as well, right? And team two is sort of similar. The limit is at 16.7, minimum is 3. So just to make sure we diversify. And however, in team four, because the relative volatility is way lower for healthcare relative to the other two, we have increased the limits to 20 and not more. So it really depends on a lot of factors. This is quite a tough question to answer in an easy manner because it's not humanly decided. It's really based on the metrics of data. So in general, traditional portfolio optimization requires expected return, expected volatilities, and correlation metrics. It's the same here. We need all three, but we have more emphasis on the expected volatility and correlation than expected return. ERA places equal emphasis for all other products, but in thematics, more emphasis on second and the third one. I hope that explains it a little bit better.
Thank you. Thank you so much, Freddy. Another question that we had from an audience member here is a little bit more about I don't think we addressed this too in depth earlier, which is that with regards to the ETFs that we use for thematic portfolios, are these actually actively or passively managed?
ARK, as a good example I mentioned before, was commonly known in the marketplace as actively managed. But in our opinion as StashAway, we don't see them as actively managed like how market participants are doing. They are actively changing the basket of stocks based on the potential long-term upside versus the downside that they see. So they maintain a certain ratio, they evaluate the phases of growth of the company, right? So for example, they are early stage. They could be investing in something when it's less appreciated by the markets. But as over time, something did very well, and the upside, as it goes up, the upside is shrinking versus its downside. ARK seems to be very active in trying to change the composition towards other things that's attractive. So they maintain this high risk-reward ratio, right? So hopefully that comes true. So ARK is a good example where we actually like the fact that they actively curate the basket of companies they invest in, but they are not active managers by our definition. I think it's unfair for the industry to bucket them as active managers, because active manager is like using the market to explain the market. Because the market is up, I buy it. That's not good. That's momentum factor. So that's not a factor you want. You want a factor that's not known today. The potential is not well understood other than by scientific experts, technology experts, and ARK funds in particular. Majority of the employees are experts in a subfield. None of them are really market person other than Cathy Wood. Most of them are futuristic expert, right? So that's what we like. And I think that would disentangle decision making from market performance, yeah, and focus on the structural trend that Stephanie has mentioned.
Great, thank you so much for that, Freddy. And Maybe just to quickly mention as well on that note on ARK ETFs, we're actually hosting a panel with ARK Invest on the 20th of this month. So in a couple of weeks, we're hosting a webinar with them at 8 p.m. Singapore time. So we've not posted the event yet, but you can follow us on Eventbrite and our Facebook page to keep a lookout when we publish the event. All right. So jumping right back into the question, I think we've been able to answer pretty much all of it, but I think I see one right now, which is a little bit about fees, Freddy. And I guess in particular, the expense ratio for the thematic portfolios, the ETFs in there, and how that compares to, I guess, normal ETF fees or maybe our general investing portfolio fees.
Yeah, when it comes to thematic, the way to look at fees is, in general, industry average, the thematic fees are generally a lot higher than the traditional assets. However, for us, it's about 0.5 percentage point on average. However, it's also because but it's not that comparison of fees shouldn't be absolute level only. You should think about the volatility. So a lot of us wouldn't mind the higher fees in transacting in Bitcoin or Ethereum because it's a lot more volatile and hence more opportunity. But in the case of thematic, it's actually better in a sense. It's a lot more diversified than buying something like a coin. And it has this disruptive nature. But because of the amount of effort involved to put it together is a lot more involved for the ETF manager, the fees are generally higher. So for us, we already screened through the best in class, like in terms of liquidity, in terms of support, in terms of research, in terms of expertise, but we also did our best. And to average the fees of around 0.5% is actually very competitive. I've seen thematic ETFs that could cost you a lot more. If you buy a crypto-linked ETF, sometimes it's 1% or 1+, right? So what I'm saying is that to be able to invest in very disruptive part, the higher fees should also be viewed versus its higher potential and its higher volatility. Higher volatility product will tend to have higher fees, higher disruptive, higher potential products similar. Yeah. So we didn't make our best effort. It's not in our interest to pay too much fees anyway. StashAway don't make those fees. We would ideally want to minimize it even more as time passes by, as those markets open up. That's why sometimes we may see changes. We may replace the ETFs over time, or maybe the ETF would drop the expense ratios over time on their own as well. So again, this is still a very good discovery phase for thematics. Hence, the fees wouldn't be like traditional. Yeah, I'm not going to justify, but I think for the expertise, the ETF fund managers given the 0.5% fees are not. It's not outrageous. It's quite low.
Thank you, Freddy. We actually have a follow-up just on the fees question from Travis, which is, does StashAway get a discount on the ETFs compared to retail?
We get institutional grade fees anyway. That's how we work because of our volume, and we pass it fully back to users. In general, that's how we negotiate, and we don't take any of the differences. It's always passed back to users. So what you get is institutional from us. A retail will be a lot worse, right? So yeah, that's a short answer.
Thank you so much, Freddy. And then we have one question, which is, if we were invested in the thematic portfolios and we wanted a certain percentage exposure to the theme, it seems like the protective assets reduce the actual exposure percentage. So how should investors go about planning this thematic exposure relative to their overall investment portfolio?
Well, I think we covered a bit with my personal example, but I can give you a rule of thumb just to be clear. Think about downside first. Don't think about upside, because these things are exponential. When they do well, sky's the limit. But think about the downside. If you invest 10% of your net worth in a team, and if your StashAway risk index for that thematic investment is 45, you're risking 4.5% in an extreme case, right? Are you comfortable with a particular team generating 4.5% impact on your total net worth? If it's too much, you want to be more diversified, you want to lower it to 2, then obviously you can't invest 10% of a net worth. You should do 5%. But if you also can say, wow, maybe I can bring it lower, the thematic investment to SI 20 or 25, then it will be okay to invest 10% of my money in it. So there's two ways to think about it. right? You think about it as the highest risk point, or you think about it as your own risk point. That is to help you guide your selection. So if you lower your risk in the thematic portfolio, you can have more. Or you can choose to have maximum risk in the thematic and have less amount committed to it. It's your choice. Yeah.
Great. Thank you so much, Freddy. I'm just looking through the Q&A now, and I think we were actually able to get through pretty much all of them. And maybe I have one last question for both Freddy and Stephanie, but before we jump into that, if you think of any other questions after today's session, please feel free to reach out to us, to our client engagement team. You can email us, drop us a WhatsApp, give us a call. We're happy to talk you through any of the portfolios, help you open an account, anything like that. So feel free to reach out to us. And I think, we're just past the hour mark, Freddy and Stephanie, and I think a good way to perhaps end this is maybe for all of the attendees tonight, maybe just kind of one advice you would like for them to take away from this session. It could be about thematics, or it could be more broadly, we're entering the last quarter of the year. And so, something you want them to take away from the session.
Well, judging by the questions and so on, I have a few things to say. Some of you mentioned the impact on our global portfolio with KWEB, and also see questions about whether Freddy and Stephanie personally invested in the teams. I can tell you this, I have not yet done so because I'm still planning, but when it comes to KWEB, I bought it every single week during July, every single week since, and 6 feet, like big numbers, because it's something I believed in. So for us as StashAway employees, founders, a lot of us, we have been around for 4.5 years now. We have a long-term track record that's fairly impressive, including this year's lack of performance. We believed in it. A lot of us actually deploy monthly contribution of our savings to it. Some of us commit big percentages because we believe in growing our own wealth with what we designed. And in my case, when we make the reoptimization in July 21st and 2nd, I personally invested a lot more into KWEB and our own portfolios, simply because that's our beliefs. So same thing with teams. Every time I launch something doesn't mean we can always put a lot of money in there. But what we believe in is to always have savings every month. And those savings can go into regularly going into the new things that we believed into. So in thematic, personally, for me, I'm looking to build it up over the rest of the year through a regular savings that I have after income minus expenses, because I already fully invested a lot in the global portfolio. In particular, all of you know now I'm SI 22. It doesn't mean that's the best portfolio, but it's sort of just my natural preference. And when I invest in the teams, I'm going to do the same thing, SI 22. If I cannot invest a lot, I may go SI 45 because I'm going to invest less, but I want more exposure. So that's what I will build up every single month from my income less expenses. So that is what I'm going to do. Have done in the past with the global, but I'm going to do for the thematics. So hopefully that answer anonymous questions on that. Stephanie herself, she has her own plans. She's been a sound supporter herself, so I'll let her speak a piece. But I just want to answer a few questions for the ending. Yeah, Stephanie, why don't you end it?
Yeah, I guess I mean that was a very, very nice closing by Freddy. So I only have one more thing to add, and it's think about when you start investing with StashAway, like the first thing we ask you is a customer profiling. What is the risk level that you're comfortable with? A lot of banks or mutual funds or even financial advisors ask that question for the sake of just asking a question and just to pass compliance. When we ask you that question, I mean, we really mean it to help you to ride through volatilities. So when you answer that question, like really think about what is the drawdown, what is the volatility that you can withstand, and also link that to your long-term goals, right? For example, I mean, for my StashAway investment, I have a higher risk tolerance because I save it for my retirement, which I don't need for quite some time. And for different time horizons, I mean, you have different risk preferences as well. So like stay true to your risk index, and that's what we hope to deliver to like as value from StashAway to our customers.
And for Amanda's ending, I share a screen for people who attended this channel today.
Thank you so much, Freddy. Yeah, so we are running a promotion right now. And you get free investing up to 12 months if you invest some fresh funds into our thematic portfolios. The details are as you see on the screen. Okay, and we're just going to leave it there for a couple of 1 or 2 minutes. If you don't catch this right now, you can also reach out to our client engagement team who can share more details about how it's going to work. And with that, I just wanted to quickly thank once again Freddy and Stephanie for taking time out to join us for the session, sharing your insights, telling us a little bit more about thematic portfolios. And for everyone, thank you so much for taking time out of your Tuesday evening to join us and learn a little bit more about these new portfolios that we have. I hope that you have a great rest of your evening, and thank you so much.